Hi, everybody. Mike Sorrentino here, along with Bepin, and we're here to celebrate a birthday today. It is the bull market's second birthday as of October 12th. I think that's right, Bepin. It was like 2 years ago when we finally reversed course and the bull market began. And one of the greatest, I guess, euphemisms I could think of in a bull market is that they don't die of old age. They don't. There's this idea that after we've seen stocks go up for a while, that the time is done. It's done. It's over. Bull markets have a shelf life effectively, and that is just not the case. And if you go back in history, bull markets are sometimes a couple months, oftentimes a couple years. We've seen ones that have flirted with a decade. And if you look at the data, this is still historically speaking, we're in the early innings of this bull market. So remember, keep in mind that they don't die of old age. And the reason why we mention that, the reason why we're starting with that point is because there is a potential for a fair amount of chaos over the next couple of weeks. Yes, you read my mind. We're talking about that presidential election in early November, less than a month away. We will find out who will be the next president. Well, technically speaking, we will find out, but I don't know.
Maybe,
It
yeah.
might take a little bit longer. We'll
Few
see
extra
how long it
days
takes to.
sometimes.
Oh, yeah, counting those votes might take a little bit longer than we thought. But from Sun Tzu, all right, from Art of War, in the midst of chaos, there is also opportunity. And I love this quote simply because when we hear the word chaos, uncertainty, those types of words, I think our natural reaction as human beings is to get defensive, get nervous, set up protections around us to make sure that nothing bad happens. But the irony in our world, Bepin, is that when we hear chaos and when we hear uncertainty, there's only one word that we should be thinking about, and that is, of course, opportunity. And that's what we're going to focus on today because we do see some potential for chaos over the next couple of weeks. And I don't think that is groundbreaking. I don't think that is very, frankly, all that smart or intuitive. I think it's just obvious to a certain degree that when you get towards an election day, markets tend to get choppy, particularly the S&P 500. If you see here, this is an average year. This is a portrayal of an average election year and what happens from day zero to day 200 and what, how many trading days are there? 250 something, 252 trading days, something like that. But these are the trading days for the S&P 500. And as you can see, an average year, there tends to be volatility at the beginning of the year, but more importantly, it tends to be right before the election. As you can see, that gray shaded area on the right, that's where we are right now. So let's talk about this. Let's be honest and be real that this might happen. We don't know. Look, September was a surprise. We talked a month ago about how September tends to be a bad month. Guess what? It was a great month. October also tends to be fairly volatile as well. We'll see, but there is a potential for volatility. So really what we think about here is how do we handle that going forward?
And like you mentioned, Mike, if history is showing us that stocks tend to do on an election year during the third and fourth quarter, they tend to be about sideways and choppy movement. Why don't we just sit this one out? Why don't we just move to cash? And the chart below here that you're looking at is showing what the S&P, investing in the S&P 500,000, putting 100,000 in it. The dark blue line is showing over the last 70 years what that would have grown to had you just bought and held. The light blue line is showing had you bought and held, but you moved to cash in the second half of each election year. As you can see, trying to time the market based off of politics, it didn't work out so well. Yeah, you lost about half the gain you would have gotten by just buying and holding. And that's really why you never know when the rally is going to start. Like Mike said, we thought September was supposed to be a typically volatile month. It ended up being a great month. So that chart we were looking that Mike was going over was showing the average movements throughout a year. So there's some movements that happen earlier, some that happen, the growth rally starts in September, or maybe it starts in November, like last year, where we got it. Actually, it was closer to October, but you just never know is the main point. So we never participate in market timing here. We don't base our allocations based off the political calendar. It's a fool's errand. We leave our politics at the door when we get to investing.
Well, I would also like to point out that if we're using history as a guide here, I would say that most historical data is overwhelmingly supporting staying in the market.
Yeah.
I love this chart. I know there's a lot of numbers, a lot of dates. What the heck is going on here? What we're basically saying here is that when you tend to see the final 2 months of a year being bullish, which again, if you go back to that data in an average election year, after you get to the election, you tend to see a rally into the end of the year. So if we saw positive November and December this year, what does that mean for the subsequent year? And I think what it shows here more than anything else is looking at this red dotted box on the right. The following year, okay, let me be very clear. When November and December of a year are positive, okay, what you tend to see is the next year, the average return for the S&P 500 is close to 20%. It's 19.5% on average. I think what's most interesting, frankly, is that 100% of the time that this has happened, 100% of the time, the market's been higher a year later.
That's incredible.
It's great data. It's great data, but I'm not done. I'm going to beat a dead horse today because I feel like it. Some might say, well, Mike, Bepin, that's fine, but the Fed just cut interest rates. The Fed cut interest rates by 50 basis points. That tends to be a scary thing in markets. And they did it around an all-time high. It's never happened before. Do you know how many times I've heard that over the past 3 or 4 weeks? This has never happened before. Hate to tell you, it's happened like 20 times. These are all the 20 times that the Fed has cut interest rates within 2% of an all-time high in the S&P 500. All right, 20. Going back to what, 1980. So it's not like going back to the Great Depression or anything crazy like that. Now, if you look at the overall data, again, similar story. When the Fed has cut within 2% of an all-time high, a year later, the S&P 500 has been up by an average of almost 14%. That's over 4% more than the long-term average of the index. Massive outperformance. And again, similar story, 100% of the time the market is up. Now, we all know past performance does not predict future returns. We all know that. But oftentimes history rhymes for a reason. And I think we could see that again here.
And it's not just stocks. Obviously, we've talked about this on previous episodes. We are very bullish on bonds. And as this chart shows below here, it's looking at various different fixed income asset classes. The dark blue line is going to be the S&P 500. The rest are all various different fixed income indexes. And as you can see, it's showing the returns after the first rate cut over the last 6 cycles. And as you can see, if you focus on the 1 year, 2 year, and 3 year, bonds give you a heck of a lot of the same return that the S&P 500 does. It might not be exactly or dollar for dollar. Obviously, stocks tend to be higher growers, but that's not a bad bet in terms of getting 70, 80% of the return in stocks with a lot less volatility. So that's why repeatedly throughout this year, we've been increasing our fixed income allocation across our core models. Just in preparation of that. So should we see some extra volatility? Should we see some choppiness due to the election? We do have that ballast in there, which is the fixed income allocation that we've been increasing throughout the year. And really, when we look at other asset classes, so the world isn't just U.S. large cap and bonds. The chart you're looking at here is of the infamous lost decade. That's from 2000 to 2009, coming off of the dot-com bubble and then finishing up with the great financial recession. One of the other key areas that we've been looking at throughout the year is diversification, which we're always looking at diversification, but this year more in particular, just because all the focus has been on large cap growth. And it's been like that for the last 5, 6, 7 years. But looking at the returns during the lost decade, you might think that everything must have been red during this period. It was the lost decade for a reason. But the reason we remember it as the lost decade is just basically because we're focused on large cap growth stocks at all times. But when we look at other asset classes like international, emerging markets, small caps, all these blue lines to your left, we see that they actually saw positive performance. So the world doesn't always revolve around the U.S. or in particular U.S. large companies. And we want to keep increasing our diversification for these potential periods. I mean, not saying that we see another dot-com bubble coming, but I think a lot of people are making similarities between the AI rally that we've seen this year and the 2000 dot-com bubble. Should something like that happen, this is why you need to hold other assets. This is why you need to hold international, small caps, bonds, of course. Bonds have been beaten up for the last 3 years, and a lot of investors are underallocated. We have not been one of those. So really going forward, we just want to make sure that we have good diversification across different asset classes, not putting all our eggs in the US large cap growth basket. And with that, we'd like to thank you for tuning in. You should expect another episode in 2 weeks. Have a great weekend and take care.